Have you ever wondered why some people quietly become millionaires while others work their entire lives and still struggle financially? Here's the surprising part. It usually isn't because they earn more money. It isn't because they're financial geniuses. And it definitely isn't because they were lucky. The biggest difference is simple. They started investing. The problem is that most people never take that first step. They keep telling themselves, I'll start when I earn more. I'll wait until the market crashes. Investing is too risky, or the biggest excuse of them all. I don't know where to begin. If that sounds familiar, you're not alone. Millions of people have money sitting in a savings account that's slowly losing value because of inflation. Every year they wait, their purchasing power gets weaker, while people who invest allow their money to work for them. And that's exactly what this video is about. By the end of this video, you'll know how a complete beginner can start investing from scratch, how to avoid the biggest mistakes that cost new investors thousands of dollars, and how to build a simple portfolio that doesn't require you to watch the stock market every day. The best part? You don't need a finance degree, you don't need thousands of dollars, and you don't need to spend hours analyzing charts. You just need the right system. But before we begin, one important reminder. This video is for educational purposes only and shouldn't be considered personal financial advice. Always do your own research before investing because every financial situation is different. Now let's get started. The first mistake beginners make has nothing to do with choosing the wrong stock. In fact, most beginners never even buy their first investment. Why? Because they get trapped in something called analysis paralysis. They watch dozens of YouTube videos, read hundreds of comments, download investing apps, compare different strategies, and somehow, months later, they still haven't invested a single dollar. They're waiting for the perfect time. But here's the truth. The perfect time almost never exists. The market will always give you a reason to wait. Some days people say stocks are too expensive. Other days they say a recession is coming. Then someone predicts a market crash. And before you know it, another year has passed. Meanwhile, disciplined investors continue investing month after month, regardless of the headlines. History has shown something interesting. Markets go up, markets go down. But over long periods, they have consistently rewarded patient investors. That's why your biggest goal as a beginner shouldn't be finding the next hot stock. It should be building the habit of investing consistently. Because investing isn't about getting rich overnight. It's about giving your money enough time to grow. And once you understand that, everything becomes much simpler. So, you've decided that you finally want to start investing. Great, but now you run into another problem. Where should you actually invest? Today there are hundreds of investing apps and brokerage platforms. Some have flashy designs. Some promise zero commissions. Others advertise advanced trading tools. For a beginner, it can feel like every platform claims to be the best. Here's the reality. The platform matters, but not as much as people think. The biggest mistake beginners make is spending weeks comparing apps instead of actually investing. Don't let that happen to you. Instead of searching for the perfect platform, focus on a few things that really matter. First, security. Your money should be with a well-regulated brokerage that's licensed in your country and has strong investor protections. If you can't trust the platform, nothing else matters. Second, low fees. Small fees don't seem important at first, but over 10, 20, or 30 years, they quietly eat away at your investment returns. A difference of even 1% per year can cost you tens of thousands of dollars over your lifetime. That's why experienced investors always pay attention to costs. Third, investment choices. Choose a platform that gives you access to individual stocks, ETFs, and index funds. Even if you don't plan to buy everything today, having those options will help as your investing knowledge grows. And finally, simplicity. A good investing app should make investing easier, not more confusing. If you open the app and feel overwhelmed by dozens of charts, indicators, and flashing numbers, That's probably not the best place for a beginner. Remember, your goal isn't to become a day trader. Your goal is to become a long-term investor. Now, once you've chosen your brokerage, you'll usually be asked to verify your identity. Don't be surprised if they ask for things like a government-issued photo ID, your address, your tax information, and sometimes a quick selfie for identity verification. This isn't because they're invading your privacy. It's because regulated financial companies are legally required to verify their customers and help prevent fraud. The process usually takes only a few minutes. After your account is approved, you'll finally reach the point where you can fund your account. And here's something I wish every beginner understood. You don't need thousands of dollars to begin. One of the biggest myths about investing is that it's only for wealthy people. That's simply not true anymore. Many brokerages now allow fractional investing, meaning you can buy a small piece of expensive companies instead of purchasing an entire share. So even if a company's stock costs hundreds of dollars, you can often start investing with much less. The important thing isn't how much you start with. The important thing is that you start. Because once your money enters the market, time begins working in your favor. And that's something you can never buy back later. But now comes the biggest question of all. You've opened your account. You've added money. Now what should you actually invest in? Thousands of stocks, hundreds of ETFs, countless investment options. How do you know which one is right? All right, this is the moment where most beginners get stuck. They open their investing app, type in a few famous companies, see thousands of options, and suddenly think, what if I choose the wrong one? Here's the good news. As a beginner, you do not need to find the next Apple, Tesla, or Nvidia. In fact, trying to pick winning stocks is one of the fastest ways for new investors to make mistakes. Instead, imagine you had two choices. Option 1, one company. Option 2, 500 companies. Which one is safer? For most people, the second option is the smarter choice, and that's exactly what an index fund does. An index fund is simply a basket of many companies. When you buy one share of an S&P 500 index fund, you're instantly investing in hundreds of America's largest businesses. That means your money is spread across companies like Apple, Microsoft, Amazon, Google, and many others. If one company struggles, the others can help balance things out. This is called diversification, and it's one of the most important concepts in investing. The simple portfolio I'd build as a beginner. If I were starting from scratch today, I'd keep it incredibly simple. For a young investor with a long time horizon, I'd focus on three types of investments. U.S. Stock Index Fund, 50%, International Stock Fund, 40%, Bond Fund, 10%. This gives you exposure to the U.S. market, companies from around the world, and a small amount of stability through bonds. Notice something important. There are only 3 investments, not 20, not 50, just 3. Because successful investing is often much simpler than social media makes it look. Your first purchase. Let's say you deposit $100 into your account. Instead of trying to time the market perfectly, you could simply invest according to your chosen allocation. $50 U.S. Index Fund, $40 International Fund, $10 Bond Fund. That's it. Congratulations. You're now invested in hundreds or even thousands of companies around the world. The strategy that removes emotion. Now here's the part that separates long-term investors from everyone else. Set up automatic investing. For example, $50 every week, $100 every 2 weeks, $250 every month. Whatever fits your budget. This strategy is called dollar cost averaging. When prices are high, your money buys fewer shares. When prices are low, your money buys more shares. Over time, this helps smooth out the impact of market volatility. More importantly, it removes the pressure of trying to predict the perfect time to invest. Because let me tell you a secret, even professional investors struggle to consistently time the market. A quick reality check. Imagine 2 people. Person A waits for the perfect time. Person B invests consistently every month. 10 years later, person B usually ends up far ahead, not because they were smarter, but because they actually got started. And that's the biggest lesson of this entire video so far. Consistency beats perfection. But before you get too excited, there are a few beginner mistakes that can completely destroy your returns. Things like chasing viral stocks, panic selling during market crashes, and investing money you'll need next month. These mistakes are responsible for more losses than bad investment products. Now that you've built your portfolio, there's one thing that can still ruin everything. And surprisingly, it has nothing to do with the stock market. It has everything to do with your emotions. Most people don't lose money because they picked a terrible investment. They lose money because they make terrible decisions after they invest. Let me explain. Imagine the market suddenly drops 20%. News channels are talking about a recession. Social media is full of panic. Everyone around you starts saying, "Sell before it's too late." For a beginner, that's terrifying. But here's what history has shown again and again. Market crashes are normal. They've happened before, they'll happen again. And every major market decline in history has eventually been followed by a recovery. No one knows exactly when. But patient investors have consistently been rewarded over the long term. That's why experienced investors don't panic every time the market turns red. They stay focused on their long-term plan. Mistake 1. Trying to time the market. Many beginners think they'll wait until stocks become cheap. The problem? No one knows where the bottom is. By the time people feel confident again, the market has often already recovered. Instead of trying to predict every move, keep investing consistently. Over time, this strategy has worked far better than constantly jumping in and out of the market. Mistake 2. Chasing hype. A stock goes viral. Everyone on YouTube is talking about it. TikTok says it's the next big thing. Friends tell you it's guaranteed to double. That's usually when beginners rush in. But by then, many of the biggest gains have already happened. Remember this, just because everyone is talking about a stock doesn't mean it's a good investment. Always understand what you're buying. Never invest based only on excitement. Mistake 3. Checking your portfolio every hour. This is one of the fastest ways to become emotional. Prices move every single day, sometimes every minute. If you keep watching every small movement, you'll start reacting instead of investing. Long-term investors don't need to check their portfolio every day. For most people, once a week or even once a month is more than enough. Focus on building wealth, not watching numbers move on a screen. Mistake 4. Investing money you'll need soon. The stock market is designed for long-term investing, not next month's rent, not your emergency fund, not money you'll need for bills. Before investing, make sure you built an emergency fund that can cover several months of essential expenses. That way, if the market drops, you won't be forced to sell your investments at the worst possible time. The secret most people ignore. People spend hours searching for the perfect stock, but they ignore something much more powerful, their savings rate. Think about it. A portfolio earning great returns won't grow much if you're only investing a tiny amount once in a while. But someone who invests consistently every month, even with average market returns, can build significant wealth over time. The habit matters more than trying to be perfect. Now you've learned how to choose investments, how to avoid common mistakes, and how to stay invested even when markets become unpredictable. But there's still one important question left. When should you actually sell? Because buying is only half the journey. Knowing when to hold and when it's time to move on can make a huge difference over the long run. If buying is the easy part, selling is where emotions take over. Think about it. When your investments are going up, you don't want to sell because you think they'll go even higher. But when they're falling, you don't want to sell because you're hoping they'll recover. That's why so many investors end up making emotional decisions instead of smart ones. The truth is, You should never sell just because you're scared. And you shouldn't buy just because everyone else is excited. Instead, every decision should have a logical reason behind it. So, when does selling actually make sense? Reason 1. Your investment thesis has changed. When you bought the investment, you had a reason. Maybe you believed the company would keep growing. Maybe it had strong leadership. Maybe it was dominating its industry. But if those reasons no longer exist, it's okay to rethink your decision. Great investors don't stay loyal to a stock. They stay loyal to facts. Reason 2. You need the money for an important goal. Let's say you're buying your first home, starting a business, or paying for an important life event. If your investments are helping you achieve a meaningful goal, selling some of them can make sense. After all, investing isn't just about making money. It's about improving your life. Reason 3. Your portfolio needs rebalancing. As markets move, one investment may grow much faster than the others. Over time, your portfolio can become unbalanced. That's why many long-term investors rebalance their portfolios once or twice a year. It's a simple way to manage risk without constantly buying and selling. The biggest secret isn't picking stocks. After everything we've covered, there's one lesson I hope you remember. Wealth isn't built from one lucky investment. It's built through hundreds of small, consistent decisions. Invest regularly, stay patient, ignore the daily noise, and let time do what it has done for generations. Because the stock market doesn't reward the smartest people. It rewards the people who stay invested long enough. Think about this. Imagine planting a tree today. If you dig it up every week to check whether it's growing, it never gets the chance to develop strong roots. Your investments work the same way. Give them time, let them grow, and trust the process. If you're waiting for the perfect moment to start investing, this is your reminder. The best time to start was years ago. The second best time is today. Start small if you have to. Invest consistently, keep learning, and remember, financial freedom isn't created by one big decision. It's created by the small decisions you make over and over again. If you found this video helpful, make sure to like, subscribe, and turn on notifications so you don't miss future videos on investing, personal finance, and building long-term wealth. Thanks for watching, and I'll see you in the next video.